Welcome everyone to Unit 5 of the AAA module. I'm Mary, one of your AAA module leaders. This is a short video to give you an overview of what's covered in Unit 5. Unit 5 covers the following key topics. What is materiality, levels of materiality, calculating materiality, and overall audit strategy and audit plan. So let's start with what is materiality. In auditing, the concept of materiality recognises that some matters, either individually or in aggregate, are important to users making economic decisions based on an entity's financial statements. When a misstatement or omission of information in the financial statements is significant enough to change or influence such a decision, a material misstatement has occurred. So what do we mean by misstatement? Misstatement is the difference between the actual amounts or classification, presentation or disclosures reported in the financial statements and the amount or classification, presentation or disclosure that should be in there in accordance with the applicable financial reporting framework. Note that misstatements can arise due to error or fraud. So by applying the concept of materiality appropriately, this enables the auditor to focus their work on high-risk areas of the entity's financial statements. An auditor is required to apply the concept of materiality throughout the audit process. This diagram shows how materiality is considered throughout the audit. Unit 5 specifically deals with how an auditor determines and applies materiality in the first two phases of an audit, that is, while planning the audit and performing the audit. During the reporting phase, which is at the conclusion of the audit, overall materiality is applied to evaluate the effect of any identified misstatements on the financial statements and the appropriateness of the auditor's opinion. This is discussed in more detail in later units. ISO 320 provides guidance on how auditors apply the concept of materiality in planning and performing the audit, while ISO 450 applies to the evaluation of misstatements. ISO 320 describes 4 levels of materiality, which can be broadly categorized as follows. When planning and performing an audit, materiality is set at the financial statement level, where we look at overall materiality and performance materiality. Materiality is also set at the assertion level, where we look at specific materiality and specific performance materiality. The terms overall materiality and specific materiality are used only for the purposes of this module. These terms are not used in ISO 320. In addition to determining materiality, the auditor sets a clearly trivial threshold in order to track misstatements identified. Misstatements that are clearly trivial will be of an insignificant dollar value. The auditor is required to accumulate all misstatements identified throughout the audit, with the exception of those that are clearly trivial. What is insignificant is determined by the audit partner using their professional judgment and the audit firm's guidance. We'll now go through each of the materiality levels in more detail. Overall materiality refers to the dollar amount that the auditor sets for the financial statements as a whole. Any misstatement, individual or in aggregate, which is above overall materiality, would result in the financial statements being materially misstated. To determine overall materiality, a numerical threshold, benchmark, is used as a starting point. A percentage is then applied to the chosen benchmark to determine overall materiality. The benchmark and the percentage to be applied are both based on the auditor's professional judgment. The benchmark selected should be appropriate to the circumstances of the entity. Examples of potential benchmarks include profit before tax, total revenue, gross profit, total expenses, or net assets. And when identifying an appropriate benchmark to use, an auditor would determine who are the likely users of the financial statements and consider matters such as the major elements of the financial statements that will be of interest to the users, the nature of the entity and the industry it operates in, how the entity is financed, the volatility of the proposed benchmark, or whether an alternative benchmark is necessary to address special circumstances. The selection of an appropriate percentage to be applied to the nominated benchmark also requires professional judgment. This table sets out the benchmarks and percentages commonly used in practice to determine overall materiality. Performance materiality is based on overall materiality, but set at a lower amount. The auditor uses performance materiality to determine which items in the financial statements to select for testing, and the nature, timing, and extent of audit procedures. Using this lower level of materiality instead of overall materiality reduces the probability that the total amount of uncorrected and undetected misstatements exceeds overall materiality, which would then result in the financial statements being materially misstated. ISO 320 provides no specific guidance on how to calculate performance materiality. This, again, is left to the auditor's professional judgment and is affected by issues such as the auditor's understanding of the entity, the auditor's experience in prior year audits, the nature and extent of misstatements identified in prior year audits, the auditor's expectations in the current year, and risk assessment. This table provides some percentages that are commonly used in practice to calculate performance materiality. Note that these percentages are only guidelines based on common practice. Different audit firms would have different guidance in their audit manuals. And remember, when there is an inverse relationship between the risk of material misstatement and performance materiality. So if the auditor determined risk of material misstatement to be high, then a lower performance materiality percentage would be applied. Specific materiality refers to materiality set for a specific item in the financial statements, whether it's a particular class of transactions, account balance, or disclosure. In some audit engagements, there may be a need to identify specific materiality due to the need to identify misstatements which could relate to sensitive areas, such as particular note disclosures regarding senior executives' remuneration. Specific performance materiality is set in the same way as performance materiality, except that specific performance materiality is set at a lower amount than the specific materiality. Specific performance materiality may also need to be set over areas that are sensitive due to their nature of potential misstatement and their occurrence, rather than their monetary size. Once an appropriate benchmark is identified, relevant financial data is used to calculate overall materiality for the audit client. At the planning phase of an audit, this data might be, for example, prior period financial results, forecasts for the current period, or period-to-date results. It's common practice for the auditor to calculate what materiality is expected to be for the 12 months based on the results to date. Circumstances such as unusual or non-recurring revenue expense items might cause an exceptional variation, which may lead the auditor to conclude that they should use a normalised benchmark base. Materiality will then be revised if necessary once actual annual results are available. It's important to understand that overall materiality calculated at the planning stage of an audit may not necessarily remain unchanged throughout the audit. During the course of the audit, information may come to light that requires the auditor to revise the original overall materiality level. If overall materiality is revised, a corresponding change to performance materiality is likely to be required. In addition, performance materiality may have to be revised at any time during an audit without impacting an overall materiality to reflect revised risk assessments, audit findings, and new information obtained. Changes in performance in materiality, in turn, will result in a modification of the nature, timing, and extent of audit procedures. Overall audit strategy and audit plan. The main purpose of establishing the overall audit strategy is to set the scope, timing, direction of the audit engagement and guide the development of the audit plan. One of the audit strategy's decisions is determining the appropriate audit approach. This essentially means a decision as to whether the auditor will take a controls-based approach, which is performing tests of controls and substantive procedures to gather audit evidence, or perform a substantive procedures only. The audit plan, or audit program as it's commonly referred to in practice, is more detailed than the audit strategy in that it includes the nature, timing, and extent of the audit procedures to be performed by the audit team. The following diagram shows the two main types of audit procedures that auditors use to obtain evidence: tests of controls and substantive procedures, of which there are two types: substantive analytical procedures and tests of details. In practice, a summary client audit plan is typically presented to the client to outline the audit strategy decisions as well as the required communications with those charged with governance. A typical summary client audit plan includes the following: details of the key audit team members, a brief introduction to the audit firm's methodology, materiality, significant risks identified and audit focus areas for the current year, the audit approach for key audit areas, auditor independence, timing and deliverables. Other components such as group scoping or working with internal audit would also be incorporated into the summary client audit plan depending on the client's circumstances. That sums up our overview of Unit 5. If you have any further questions regarding Unit 5, please post them on the discussion board. Thank you for watching this video. Look out for other overview videos for the other units in the AAA module. We wish you all the very best in your studies.